Welcome to the next in the Merchant Health Tech series. As part of NMBS's ongoing commitment to help its members, Merchant Health Tech series has been devised by Moorgate to provide NMBS members with some top tips to help merchant owners look at ways to grow and develop their businesses based on the Moorgate team's own experience. These bite-sized webinars will focus on important elements within your business, so by the end of each webinar, they will hopefully have provided some key takeaways for you to use within your business. Next in the series is on 13-week cash flows, and within this webinar we'll look at what a 13-week cash flow is and what is its purpose, how to build it, crucially how to use it, and what are the benefits from having it. So looking first at what a 13-week cash flow is, it's an analysis of your business's weekly cash inflows and outflows over a 13-week period, as the name suggests. It provides an insight into your short-term future cash position by projecting the weekly cash receipts, less the payments, and showing your weekly projected cash balance. In terms of its purpose, it's twofold. Internally, it helps you to manage by giving you visibility into your near-term future cash position before you get there, allowing you to take actions if you need to before they happen. Secondly, it provides visibility on crunch points, highlighting to you what your levels of cash will be in the future based on assumptions, so that if you have surplus cash, for example, you can place that on deposit and earn interest, or equally, if you have cash shortfalls, it gives you time to work out what to do. Thirdly, it gives you the ability to react quickly. So if expected payments are not received, if customers don't pay you on time, or if you have one-off costs in terms of vehicle repairs, it gives you a flexible tool to see the impact straight away and decide what to do. Externally too, it helps you to manage, most crucially from a control point of view, and it allows you to demonstrate, whether that be to your lenders, bankers, invoice discounters, or truck finance companies when you meet them, whether that's on a regular basis or if you're looking for loan facility extensions or finance for trucks, for instance, how well your business is handling cash. Next, we'll look at how to build it. So to build a 13-week cash flow, you need to establish a few things. Firstly, what your cash inflows are. These will typically be receipts, often called accounts receivable, whether from retail, cash, or trade customers, and will be received in a multitude of ways, either in physical cash, by card, or by bank transfer based on your trade account terms, or via drawdowns if you use invoice discounting or factoring. Second element is in relation to cash outflow. So these will typically be payments, often called accounts payable, will include payments related to your people, so payroll and taxes, purchases of materials, i.e. for your stock, purchases of overheads, so things like electricity and rates, and finance and funding payments for your truck leases and bank loans, for instance, and these will be made by bank transfer, direct debit, or standing order or credit card. Next, looking at cash flow patterns. This is best understood by looking back at the last 4 to 8 weeks of your bank statements and analysing them, which is actually easier than it sounds, so that you can very quickly see the timing and pattern for these receipts and payments and apply that going forward. Next is establishing what template to use. So this can be as simple as an Excel spreadsheet, or you can use more detailed modelling using data warehouse tools, things like Focus, if that's what your business uses. Lastly is about cadence, and this is quite simply who's going to own the process and how regularly you're going to update it and talk about the results. Having established those things, let's look at each of those in more detail. So firstly, looking at the receipts. So these would typically be, firstly, customer receipts. So for your retail or cash accounts, these will usually be taken at the time of the transaction, whether over the trade counter or over the phone, and that will either be physical cash, which with your end of day banking, you'll bank each night, or whatever period you choose, and usually appear on your bank statements the next business day. If they're debit cards, they'll usually appear 1 to 2 days on your bank statement, or credit cards, depending on your card provider, will typically be between 1 to 3 days. For your trade accounts, this really depends on what credit terms you've given your customers to pay, and these will usually be paid by bank transfer, either same or next day, or if your customers pay by backs, typically 3 to 4 days, depending when they send them, and relating to the monthly statements that are due that you've sent to them. If you do use invoice discounting or factoring, depending on your provider, you can usually draw down funds against your outstanding sales invoices up to 90 to 95%, depending on your facility, within 1 to 2 days. And this is typically done either daily or weekly, depending on your pattern. The second type of receipt is interest on savings deposits, which, as the name suggests, where you put surplus funds on deposit. Clearly you'll receive interest for that. Looking at the payments, there are several types. Firstly, in relation to people, there will be your payroll. So depending whether you pay weekly or monthly or both, you'll know from your external payroll company or your team, if you run the payroll in-house, exactly when and how much this payment will be each month, and will likely include pension contributions too, and usually be paid by bank transfer or backs. For subcontractors, so for people that you don't have through the payroll, so if your business, for example, does supply and fit with kitchen fittings, then based on their treatment under the CIS scheme, you can then establish when and how much these payments will be based on the jobs and the installations you're doing. Next type of payment is in relation to taxes. So these will typically have set dates and amounts, often paid by bank transfer backs or direct debit, and will relate to payroll, so obviously things like PAYE and national insurance, your sales, so things like VAT, or your profits, things like corporation tax or capital gains tax if, for instance, you dispose of certain assets. Next area in relation to payments is purchases of overheads, sometimes called goods not for resale. These will be payments you make to overhead suppliers and will typically come from your ERP system where you're processing those invoices, and likely be paid by bank transfer or backs, and cover several areas. Firstly, office related costs, so this will include things like IT for your hosting costs, your ERP license fees, finance, things like credit search, your audit and tax advice, HR, your HR software license fees, legal fees and training, marketing, digital SEO and print marketing costs, recruitment costs as and when you bring new colleagues into the business, insurance for the various policies, D&O, employer's liability or fleet, and sundry expenses, these typically from petty cash or credit cards or employee expenses. Next type of overhead expense is health and safety and facilities. So these will include things like rent and rates, heat and light, facilities costs for things like waste management, and also health and safety costs, particularly where you utilise outsourced safety advice and training. Transport and fulfilment costs, probably one of the most variable costs after people. And this will cover things like vehicle costs with the regular PMI for your vehicles, fuel, tyre and telematics costs, together with e-commerce fulfillment costs for your e-commerce channel. So that'll be things like courier, packaging, dropship license fees. Next area within payments is purchases of materials, so often called goods for resale. These will be the payments you make to suppliers and will again come from your ERP system where you're processing the payments, and again likely be paid by bank transfer or backs. And these will either be direct to suppliers where you don't have accounts through NMBS and based on the account credit terms you've set up with them, or payment on pro forma if you haven't got an account, or they'll be via your regular sort of monthly single payment to NMBS if the accounts run through MBS. Next type of payment to look at is the capital expenditure. It's usually the least frequent and typically the largest, and often they'll be financed by a loan or a lease and will appear in your 13-week cash flow as finance payments, which we'll explain in a minute. But if they are paid for in cash, then it's this payment that will appear in your cash flow. And finally, finance payments. These typically cover the capital and interest amounts and will either be lease payments, whether that's for finance or operating leases on things such as your forklifts or your trucks or your cars, or funding payments, for instance, on bank loans or interest on overdrafts. So having looked at both the receipts and the payments, let's look at the template. What we've tried to give here is just a simple example of a 13-week cash flow template. So you'll see going across the top from left to right, you've got the 13-week periods. And then down the left-hand side, you'll see firstly the balance brought forward, being the balance from your accounts, and then each of the areas that we've looked at in terms of receipts and payments. So here you have the customer receipts and the savings from deposits. And on the payment side, you've got the people and the taxes. And then here you'll see it continues in terms of the office, health and safety, purchasing materials and capital expenditure. Most importantly, you'll see the balance carried forward. So this on a weekly basis shows you the balance that you have. And what we've shown here also is the headroom, or where you've, in the unlikely event, you've exceeded your bank overdraft, which is one of the key purposes as we've set out. Again, this is just for indication, but actually hopefully shows in terms of the context of a 13-week cash flow, the type of template and how to build it. Having built it, how to use it. So the following things are worth considering. Firstly, who's going to own it? So depending on the size of your business, typically the best person to own, prepare, interpret and update your 13-week cash flow would be the most senior person, finance person you have in your business. This is because they'll have a unique view, like you as an MD or owner, of each part of your business and understand what drives the receipts and payments, so it'd be best placed to prepare and interpret it. Next point to consider is about sitting down regularly. Typically, sitting down on a weekly basis with this person will allow you both peace of mind, because as we know, cash is king, but also the opportunity to make decisions together and see the impact of them well in advance of when they need to be made. So this allows you time to then focus on growing the business. It's worth considering setting a minimum level of cash, because by doing this, by setting the level at which you're comfortable, sometimes that could be 2 to 3 months outgoings or something similar, it allows your team to manage within this and alert you if it looks like your cash flow will go below this. Probably most crucially, it's worth considering updating it weekly. By doing this, you will know, like your daily sales that you track on a daily basis, exactly what is going on within your business. In terms of the benefits, there are probably two really key ones. The first one is obviously, as we've touched on, managing the liquidity of the business, because without cash, you're not able to run your business regardless of whether it's profitable or not. So the benefits of a 13-week cash flow allow you to do this. The second, and arguably the more important one, is about being able to plan ahead, because by regularly updating your 13-week cash flow, if you see instances where either you fall below your minimum level of cash, or worse, likely to exceed your overdraft, it allows you time to determine whether it is either temporary, i.e. the cash drops and then rises again, or whether it's permanent, i.e. the cash drops and continues to do so. If it's temporary, it allows you to decide ways to address the temporary shortfall, whether that's temporary overdraft extension, timing of payments, or a payment plan with a supplier ahead of the event. If it's permanent, probably more crucially, it allows you time to ask for help from an external advisor, because the earlier you act, clearly the more options you will have. Signs that would signify a more permanent issue could be that you're struggling to pay your bills on time, or they're not being paid at all, you're constantly juggling timing or borrowing money on your own cards to make payments, or you've had final demands, whether that's letters before action or CCJs. But whatever you do, there's always a solution. If you have a 13-week cash flow, it allows you to be able to ask for help. We hope that you found this webinar of benefit, and if you have any questions, please don't hesitate to contact us directly or connect with us online to follow the work we're doing and the best practice and ideas that we share. So, thank you for listening.